Welcome to the third of the bite-sized webinars from Companies House. Now, this is a recording of our earlier webinar because we had technical issues, so thank you for watching. Now, as I said, this is the third of 5 short webinars to help you understand how to manage and run your limited company. So we're at the midpoint and it's all downhill from here. If you missed the first or second of our webinars, you can still watch them from our webinar library, and you'll find the link in the handout, which will send you if you drop us a line to webinars@companieshouse.gov.uk, and I'll make sure I send that out to you. And you can also now find our recordings on our YouTube channel. So this is the third of 5, so don't forget to sign up for the next 2. Coming up over the next few weeks. My name is Gary Townley and I'm part of the communications team here at Companies House. In the first bite-sized webinar, we covered directors' responsibilities and how to register for an online account. We then also looked at some of the digital tools and services that we offer. In the second, we covered what can be filed online and how to file online. And then we also touched on 2 services we offer, free services, our follow service and our proof service. And as I said, you can watch those from our webinar library or indeed from our YouTube channel. We'll look at today's agenda in just a moment, but let's quickly look at what we have coming up. So on the 21st of April, we are joined by the Intellectual Property Office, the IPO, who will be showing you how to identify the IP in your business. We often hear people saying, I haven't got any IP, but every company will own some type of intellectual property. Your name is a potential trademark. You'll potentially own copyright in any written material or images, etc. And if you have a website, which most companies do have these days, then it's crucial to know who owns the content of your website. And then lastly, we'll be joined by colleagues from the Business Support Helpline, and we'll look at some of the questions that we've had during this series and some of the questions that the Business Support Helpline get asked regularly. So again, sign up to those and don't miss out on those webinars. Now, unfortunately, this is a recording, so you won't be able to ask any live questions on this occasion. So we're going to swiftly move past that screen. Right, we only have 20 minutes. They are bite-sized webinars. So if everyone is ready and you are sitting comfortably, we'll begin. In this bite-sized session, we have been joined by Dave Elliott and Mark Danks from the Insolvency Service, who will be covering what a director should do if they suspect their company is indeed insolvent or going insolvent. Now, the Insolvency Service has decades of experience in understanding a company's pathway to insolvency. And today they will be discussing the telltale signs of insolvency and how managing an insolvent company incorrectly can lead to personal liability and or director disqualification. So hi both, it's over to you.
Thanks, Gary. Hi, my name's Dave Elliott and I'm one of the Chief Investigators in the Enforcement Services at the Insolvency Service.
Hi, my name's Mark Danks and I'm Head of Compliance and Targeting in the Investigation and Enforcement Services at the Insolvency Service. So, who is the Insolvency Service? Who are we? The Insolvency Service is a government agency sponsored by the Department of Business, Energy and Industrial Strategy that helps to deliver economic confidence. The agency has a varied portfolio of work. We administer debt solutions for individuals such as bankruptcy and debt relief orders, helping people to get back on their feet. We also help and support employees of insolvent companies through our redundancy payment service, paying redundancy and holiday pay from the National Insurance Fund. We are alert to abuse in the corporate marketplace and proactively monitor intelligence received from various sources, including reports from insolvency practitioners and official receivers following formal insolvency procedures, other government departments and agencies such as HMRC, and also complaints from the public.
The investigation of directors' conduct under the provisions of the Company Directors Disqualification Act is a fundamental part of our regime. And when these investigations find misconduct, we have the powers to disqualify an unfit director from running a company for up to 15 years. We're determined to tackle the most serious cases of misconduct. During 2019 to 2020, some 1,280 directors were disqualified following our investigations, with an average length of disqualification being around 5.5 years, while over 8% of the disqualifications were for 10 years or more. We have an important role in investigating live trading companies where there may be misconduct or corporate abuse. We act on information from the general public and our partners in the counter-fraud community. Our investigations help protect the public, who are often the elderly or vulnerable, from rogue company directors who abuse their corporate position through fraud, scam, or dishonesty. We investigate companies in a wide range of sectors, and we petition the court to shut them down where necessary. Investigations into 52 companies in 2019-20 showed that at least £112 million was taken from victims. Our investigations prevented the loss of a further £79 million.
Our criminal investigations team obtain evidence of possible criminal offences relating to the insolvency regime committed by bankrupts or company directors whose conduct strays into criminality. To give an example, in February last year, following an Insolvency Service criminal investigation, a 59-year-old man pleaded guilty in court to 3 counts of acting as a director of a company whilst already disqualified. He was sentenced to 10 months imprisonment, suspended for 18 months, and had to complete 250 hours of community service. Alongside him in the dock was a 58-year-old woman who pleaded guilty to an offence of aiding and abetting the other defendant to breach his disqualification. She was ordered to complete 150 hours community service. The man was also disqualified by the criminal court for a further 12 years and the woman for 7 years. In May last year, both were made subject of confiscation orders under the Proceeds of Crime Act and were required to pay £64,713 and £18,595 respectively. If they default, they will have to serve 12 months in prison. Also, high-profile cases are becoming an increasing element of our work. We deal with the protection of the company's or the individual's assets. Some of the high-profile cases we've handled recently include British Steel, Carillion and Thomas Cook.
Yeah, though most of the company insolvencies with which we deal are on a much smaller scale, and these are frequently owner-managed companies where the shareholders are also the directors. It's important that directors, and particularly new directors, understand their responsibility when the company passes the tipping point into insolvency. Directors' responsibilities are set out in the Companies Act 2006, which is available online, and we would advise all directors to read through them. Aside from the obvious responsibility of keeping the company records up to date, such as filing confirmation statements and company accounts on time, the other main responsibilities for company directors include promoting the success of the company for the benefits of its members as a whole, exercising reasonable care, skill and diligence, exercising independent judgment, and avoiding conflicts of interest.
It's when potential insolvency is on the horizon, company directors have to face a major shift in their responsibilities. When insolvency becomes a likelihood, directors must then consider the interest of all the creditors of the company ahead of their own and those of the shareholders. The Insolvency Service has decades of experience in recognising the red flags and warning signs and the consequences for directors when they fail to recognise or choose to ignore them. In our experience, we do come across company directors who do genuinely believe that they were doing the right thing for the company. It can be all too easy for directors to miss those warning signs. It is understandable, there is a lot going on, but the duty of care remains. But when considering a director's conduct in the period before the formal insolvency event, which will usually be liquidation or administration, we would examine the company's records looking at things such as cash flow, bank statements, correspondence with creditors including HMRC, and whether there was an increase in debts whilst trading continued. There are 2 basic tests for insolvency which we look for when considering our cases and the conduct of the directors. These are a cash flow test and a balance sheet test. Directors should consider using these when they have concerns about the solvency of their company. The cash flow test involves examining the ability of the company to pay its debts when they fall due.
Signs that a company is failing this test will include late payments to suppliers who may issue reminder letters, threaten or commence recovery proceedings, or place trade accounts on stop and insist on payment in advance for goods and services. Falling into arrears with payment of HMRC is also an indicator that the company is cash flow insolvent.
The balance sheet test involves considering the value of the company's assets and liabilities. If the liabilities exceed assets, the company will be what's known as balance sheet insolvent. It's possible for a company to pass one test and fail another, and we also consider the conduct of directors on a case-by-case basis and consider what they knew or ought to have known at the time and what actions they took.
So by way of example, we recently had a case before the court where the directors of an archaeology company failed to ensure that the company complied with its statutory obligations to submit VAT returns to HMRC on time. And they continued to trade to the detriment of HMRC with respect to pay-as-you-earn for several years. In the absence of returns, HMRC raised assessments which the directors knew did not reflect the true liability due to HMRC. They knowingly paid against these assessments, thinking that they could delay the inevitable. But at liquidation, £173,000 was owed to HMRC in respect of VAT, and on liquidation, unsecured creditors totaled £350,000, of which £255,000 was owed to the Crown. The accountants told us that they had prepared the returns, but they were never instructed to submit them, and that when the full extent of the debt became known, they recommended that for the good of the company and its creditors, insolvency advice should be obtained from a UK insolvency practitioner to consider all the options available. The directors said that they had not set out to treat HMRC adversely compared to other classes of creditor, but staff and suppliers had to be paid as a priority. Each director was disqualified for 2 years.
A very important point that often gets misunderstood is that you don't have to be a director registered at Companies House to be considered as a director. The Companies Act defines a director as any person occupying the position of director by whatever name called. So, if you act in the position of a director, you're essentially a director. This can include being what's known as a shadow director if the appointed directors are used to acting on your instructions.
It must be remembered that the protection afforded by limited liability is a privilege, not a right. Directors need to be aware that trading whilst insolvent, which is sometimes referred to as wrongful trading, can lead to being held personally liable for the debts of the company and to the subject of disqualification proceedings under the Company Directors Disqualification Act. It's important to try and have this consideration in our minds at all relevant times. Directors need to recognise and be honest about the true circumstances of the company. They need to have honest, open conversations amongst themselves and with their advisors. They need to assess if insolvency is a distant possibility or inevitable. Does the company have any realistic hope of refinancing? Can the company be restructured and possibly trade out of the situation? If the answer is no, it's important that directors must then start considering creditors. If misconduct is found to be present by the court, directors may be disqualified by court order or under the Company Directors Disqualification Act 1986 for a period of between 2 and 15 years. A compensation order may also be made for the director to repay specific amounts to creditors who lost out as a direct result of their actions.
During the period the director is disqualified, they cannot act as a company director. The order or undertaking cannot be avoided. This also means they cannot get other people to manage the company under their instructions. The risk here is real, as those people may also be prosecuted. The disqualification is made available to the public. Companies House holds the public register of disqualified directors, and the Insolvency Service also holds an online summary of disqualifications obtained during the last 3 months, which includes details of the unfit conduct that led to the disqualification. During the period of disqualification, a person cannot act as a company director, irrespective of whether or not they are formally appointed as such on the register held by Companies House.
But this also means that they cannot get other people to manage the company under their instructions. As we mentioned earlier when we gave examples of the criminal investigations and prosecutions, if a disqualified director breaches the restrictions imposed upon them, criminal proceedings may be commenced.
There are other restrictions for disqualified directors under the Companies Act, and these can be found on our pages on gov.uk. There are also many other restrictions placed on disqualified directors by other laws and regulations, so anybody disqualified should seek professional advice.
If you contravene a disqualification order or undertaking, you could be fined, go to prison for up to 2 years, and have any disqualification period extended. You could also become personally liable for any debts of the company that are incurred while you are contravening the order or undertaking. If you ask someone else to act on your behalf, then that person could also be prosecuted and or disqualified and become personally liable for the company debts.
An insolvent company doesn't necessarily have to cease trading, but it does require positive action from its directors. Those actions may allow the company to continue to trade. The first thing we'd recommend is to seek professional advice. Appropriate advice to your personal situation could come from a number of sources, such as Citizens Advice, an authorised insolvency practitioner. You can search for an insolvency practitioner on our website, a solicitor, a qualified accountant, a reputable financial advisor, or from a debt advice centre. You can also get some advice from the charity Business Debtline at businessdebtline.org. We have more information on options when a company is insolvent webpage.
For any further information, head to gov.uk/insolvency service. On our homepage, you'll find a link to the insolvency inquiry line if you want to contact us. We can give you general information about insolvency, what official receivers do, and where you can go to get the information or advice you need.
We can't give you legal or financial advice, information on specific insolvency cases, information or advice on matters directly relating to other government departments.
That's brilliant. Thank you very much, both. Now, we did have a few questions in prior to the webinar, so if you're happy to answer a few, I'll just run through what I've got here. So we've had one that says, I've heard the term conflict of interest, but this is something I don't really understand. Can you give a bit more of an explanation?
Yes. So by way of example, I recently dealt with a group of companies, 3 in total involved in the group. One built the nursing home, one ran the nursing home, and one managed the employees. Once the home was completed, the main director, who was a common director to all 3, took advice from the group accountant and wound up the building company, transferring the various assets from the building company to the other 2 companies. This meant in effect that the creditors of the building company were left high and dry to the tune of around about £220,000. He had a clear conflict of interest. What may have been best for the group was clearly not best for our company or for its creditors.
Okay, I think that's given a bit more explanation of that one. Yeah. Another question we've had in beforehand is, it says, I believe you investigate live companies. I have been having trouble with one of my suppliers and want them investigated. What shall I do?
Yeah, we do have the power to investigate live limited companies where information which we receive suggests corporate abuse. This may include serious misconduct, fraud, scams, or sharp practice in the way the company operates. After we receive a complaint, we assess it and consider whether we can investigate it, and if it's in the public interest to investigate. We receive several thousand complaints a year from members of the public and other regulators, and we cannot investigate every company we receive a complaint about. What we can't do is help you to resolve any differences you have with a company, help you to recover any money a company owes you, or intervene in a dispute between a company and its shareholders, or resolve a dispute within a company's own management. In these sorts of circumstances, it might be more appropriate for you to seek independent legal advice, which may be from other regulators or organisations, but always check if they will charge a fee for that advice.
Okay, that's very sound advice, really, isn't it? Okay, we'll go for one more, I think. Yeah, there we are. We have been dealing with a company who owe us money. I know that they got a COVID bounce back loan and used it to pay off their own debts. What's happening with these type of cases?
Okay, well, I'm sorry that I can't be more definitive in my answer. This is a rapidly evolving situation at the minute, to be honest. What we are trying to do is view the matters in the round to understand how the company was placed, to see what exactly the directors did with the money. Was it applied in a way which benefited the company? Clearly, taking the money and buying a Porsche for your partner isn't likely to keep the company going forward. If it was used to reduce bank loans, say, then we could see this as a personal benefit, but But if the net result of that was that it meant the company reduced its interest payments, then a case could be made out that it was intended to help going forward. So it's something we're discussing regularly and taking it very much on a case-by-case basis for the time being.
Okay, I think that's all the time we have for the questions. Now, I hope today's webinar has been of use to you, and I thank you for listening to the recording. I'd like to thank Mark and Dave for delivering today's presentation. Certainly give me insight into the role of the Insolvency Service, so thank you both.
Thanks.
All that it remains me to do on this occasion is to thank you for watching this webinar. If you have any questions about today's subject, or as I said, you want a copy of the handout, please drop us a line at webinars, that's webinar with an S on the end, so webinars at companieshouse, all one word, .gov.uk. Don't forget to sign up to the next webinar in this series, which will be with the Intellectual Property Office. And lastly, don't forget to sign up to our email updates, and we can then send you regular information about what's happening in the world of Companies House to keep you all up to date. So again, thank you very much for listening. Thank you to Mark and Dave, and we'll catch you next time.